The day money changed without anyone noticing. The shift won't come with a headline. There won't be a breaking news alert saying your mortgage just got cheaper. There won't be a notification telling you the rules of money quietly changed overnight. Instead, it will feel like nothing happened until years later, when you look back and realize your money buys less, your income is higher, and your debt somehow feels smaller. That's how the system resets itself, not through destruction, but through slow, controlled erosion. The kind you don't fight because you barely notice it happening. And right now, that process is already in motion. The battery you didn't know you were holding. Imagine every dollar you own as a battery, not a static object, but a unit of stored energy purchasing power. When the battery is full, it buys more. When it drains, it buys less. Inflation is not just rising prices, it is the slow draining of that battery. And here's the part most people miss. When the value of money drains, the value of debt drains with it. The number printed on your mortgage doesn't change, but what that number means in real-world effort becomes smaller over time. You're not paying less dollars, you're paying with weaker ones. The problem too big to pay back. The United States is carrying a debt load so massive that traditional repayment is unrealistic. Numbers like $30 trillion or $40 trillion don't behave like personal loans. They operate on a different level entirely. Governments don't pay off debt the way individuals do. They manage it, they stretch it, they roll it forward, and when the burden grows too heavy, they rely on a method that has been used quietly for decades, making the debt easier to carry by reducing the value of the currency used to repay it. Not default, not collapse, just dilution. The invisible strategy, financial repression. There's a term for this strategy, though you rarely hear it outside financial circles. Financial repression. It sounds complex, but the idea is simple. Keep interest rates lower than inflation. That's it. When inflation runs at 4% and your savings account earns 1%, your money is losing value every year. At the same time, if your debt is locked at a low fixed rate, you're effectively paying it back with money that's becoming less valuable. This is not an accident. It's a system design. Why interest rates won't save you. Many people believe rising interest rates solve inflation. In theory, they can. But in practice, raising rates too high would make government debt unbearably expensive to maintain. Every percentage increase means billions, sometimes trillions more in interest payments. So there's a limit. Rates can rise, but not too far. Not enough to fully protect savers. Not enough to completely stop inflation. That gap is where the system works its quiet magic. History already showed you the answer. This isn't a new experiment. After World War II, the United States faced enormous debt, over 100% of GDP. Instead of aggressively paying it down, the country allowed inflation and economic growth to slowly reduce its real weight. By the 1970s, the debt to GDP ratio had dropped dramatically. But here's the catch, savers paid the price. People who held cash saw their purchasing power shrink. Meanwhile, those who owned real assets, especially homes, benefited massively. The system didn't reward caution, it rewarded positioning. The winners were quiet, but they were there. Picture someone in the 1950s with a fixed-rate mortgage. Their monthly payment stayed the same, but their income increased over time. Prices rose, wages rose, and suddenly that fixed payment felt smaller and smaller relative to everything else. Over a decade or two, what once felt like a heavy burden became almost trivial. They didn't outwork the system, they simply stayed aligned with it. The losers did everything right and still lost. Now picture the saver, the disciplined one, the person who avoided debt, saved cash, and trusted the bank. Their balance may have grown slightly, but inflation ate away at its real value year after year. They didn't make a mistake. They followed the rules they were taught, but the rules had changed, and that's the uncomfortable truth. The system doesn't always reward what feels responsible. It rewards what aligns with its incentives. Your mortgage is not what you think it is. Most people see a mortgage as a burden, a long-term liability that needs to be eliminated as quickly as possible. But in an inflation-driven system, a fixed-rate mortgage can behave very differently. It can become a tool, not because debt is good, but because certain types of debt lose weight over time. If your interest rate is lower than inflation, the real cost of that debt is shrinking every year, quietly, automatically. The gap that changes everything. Here's where the shift happens. If your income grows even modestly while your debt payment stays fixed, the gap between what you earn and what you owe widens. That gap is not just financial, it's strategic. Over time, it changes how heavy your obligations feel. What once required effort becomes manageable. What once felt risky becomes normal. And that's how wealth is quietly built, not through dramatic wins, but through small advantages, compounded over long periods. The trap of thinking short term. The biggest mistake people make is focusing on the present instead of the trajectory. They see interest payments and want them gone. They feel emotional relief from paying off debt early. And while that may feel good, it doesn't always make sense mathematically in an inflationary environment, because when you rush to eliminate low-cost debt, you're giving up the advantage of paying it back with weaker money in the future. The system doesn't announce its intentions. There won't be a press conference explaining this strategy in plain language. Central banks don't say, "We're going to reduce your debt burden through inflation." Instead, they talk about targets, stability, and economic balance. But behind those words is a consistent pattern: maintaining enough, inflation, to keep the system functioning, without triggering panic. It's a balancing act, and it's been happening for decades. You're already participating whether you realize it or not. This isn't something you opt into. If you earn, spend, save, or borrow money, you're already inside the system. The only real choice you have is where you stand within it. Are you holding assets that benefit from inflation? Or are you holding cash that slowly loses value? Are you carrying fixed-rate debt that becomes easier over time? Or avoiding it entirely and missing that dynamic? The first realization most people have too late. Years from now, many people will look back and wonder why their savings didn't stretch as far as they expected. They'll notice that things got more expensive faster than their money grew, and they'll realize too late that the system wasn't broken. It was working exactly as designed. The difference is, some people understood it early and adjusted their strategy. Others didn't. This isn't about fear, it's about positioning. It's easy to hear this and think something is wrong or unfair, but this isn't about panic. It's about awareness. Systems don't change overnight, but they do evolve. And when they do, the people who adapt benefit, while those who stay static fall behind, not because they're less disciplined, but because they're playing by outdated assumptions. The moment you realize your mortgage is different, at some point, the perspective shifts. You stop seeing your mortgage as a ticking clock and start seeing it as a fixed anchor in a moving system. Everything else, prices, wages, costs, moves around it. That's when the real question emerges. If the system is slowly reducing the weight of your debt, why would you rush to eliminate it? Why paying off early can work against you? Paying off a mortgage early feels like the ultimate financial win. No payments, no interest, full ownership. But in an inflation-driven environment, it can mean giving up a hidden advantage. When you accelerate payments on a low-rate loan, you're effectively choosing to repay it with today's stronger dollars instead of tomorrow's weaker ones. You're removing the time factor that works in your favor. The role of income in the equation. This strategy only works if your income isn't static. Over time, most people see some form of increased raises, business growth, new opportunities. Even small increases matter, because while your income has the potential to grow, your fixed-rate mortgage does not. That imbalance is where the advantage lives. It's not about dramatic income jumps, it's about consistent progression. Where savers get caught in the system, cash feels safe. It's liquid, predictable, and easy to understand. But in a system where inflation outpaces savings rates, holding large amounts of idle cash becomes a losing position over time. You don't see the loss directly. It doesn't show up as a deduction. Instead, it shows up as reduced purchasing power. The same money buys less each year, quietly eroding its value. The shift from saving to positioning. This doesn't mean saving is bad, it means saving alone isn't enough. The strategy shifts from simply accumulating money to positioning it in places where it can at least keep up with or outpace inflation. That might mean higher yield accounts, investments, or assets that generate income. The goal isn't risk for the sake of risk, it's alignment with the system's direction. Understanding equity as stored energy. Your home isn't just a place to live, it's also a store of value. As property values rise and your loan balance decreases, equity builds. That equity is like stored energy. And just like energy, it can be accessed and redirected. The key is doing it strategically, not emotionally. The idea of using equity without losing control. Accessing equity doesn't mean giving up ownership and taking reckless risks. It means understanding how to use what you've built to create additional opportunities. In some cases, that might involve leveraging equity to invest in assets that generate income. But this step requires caution, discipline, and a clear understanding of risk. It's not a shortcut, it's a tool. Why the system needs someone to lose. For this entire structure to work, there has to be a trade-off. If debt becomes easier to repay over time, someone absorbs that cost. Typically, it's the holders of cash and low-yield savings. Their purchasing power declines, while borrowers benefit from fixed obligations. This isn't personal, it's structural. The system redistributes value quietly, without direct transactions. The language of policy vs the reality of effects. Central banks rarely describe their policies in terms of winners and losers. They focus on stability, employment, and growth. But every policy has side effects, and those side effects shape outcomes for individuals. Understanding those effects matters more than understanding the official narrative, the long game that most people ignore. The biggest advantage in this system comes from time, not timing the market, not predicting every move, but staying aligned with long-term trends. Inflation doesn't happen overnight. Debt doesn't shrink instantly. But over 10, 15, or 20 years, the cumulative effect becomes significant. That's where the real shift happens. The difference between action and reaction. Most people react to financial changes after they feel the impact. By then, the opportunity is smaller. The goal is not to predict every move, but to understand the direction and position yourself accordingly. That means thinking ahead, not just responding in the moment. The two paths ahead. From here, the path splits. One approach is to focus on eliminating all debt, holding cash, and minimizing risk. The other is to recognize how the system treats different types of assets and liabilities, and adjust accordingly. Neither path is inherently right or wrong, but they lead to very different outcomes over time. The quiet advantage of awareness, the difference between these paths, isn't intelligence or effort, it's awareness. Once you understand how inflation, interest rates, and debt interact, your decisions change, not dramatically, but strategically. You start asking different questions, you evaluate trade-offs differently, and over time, those small shifts compound. Why this conversation matters now. Periods of economic transition create both uncertainty and opportunity. The rules don't change overnight, but their effects become more visible. That's when understanding the system becomes more valuable than ever. Not to exploit it, but to avoid being caught on the wrong side of it. The final decision is yours. No system forces a single outcome. It creates conditions. Within those conditions, individuals make choices. Some align with the direction of the system. Others resist it. Over time, those choices shape results. The key is making them consciously, not by default. What happens next? The system will keep moving. Inflation will fluctuate. Policies will shift. But the underlying mechanics remain consistent. Debt, money, and time will continue interacting in predictable ways. The question is whether you'll recognize those patterns early or only after they've already played out. If you want, I can now